Hello there.
Hi, how's it
It's
going?
going well. How are you, Sharaine?
I'm doing well. Long time no see. How you been?
I'm doing well as well. Just staying busy.
Yes,
Staying busy. How about you?
yes, same here. Staying busy,
That's good.
trying to get everything in place. I'm actually going out of town tomorrow
Uh-huh.
for for a wedding in
Oh, nice.
Jamaica. So it's just been,
Jamaica,
you
that's
know how
nice.
the day before trips are. It's
Yeah.
just, running around, trying to get
Well,
everything
but you
together.
know what? I love it because it makes me so much more efficient. Like
That's true.
I know like I've got something that I need to do, so I gotta finish my stuff or be home,
Right.
right? So that I can like just be relaxed afterwards.
You
So
you are so right about that. It does force you to like, let me get everything that I need to get together before I go on this trip. So that way when I get there, I can just relax and enjoy myself. So yes, you are right about that. That is the one good thing. It's
I
always a
love
little chaotic, but
It's true.
that's
It's
the
true,
good
but
thing
it is.
about it.
I hear you. It's not easy. It's not easy, but it pushes us, right? So that
It does.
we can just get things done. We get more done and we don't realize it. So
Right,
I kind of
right.
like the pressure.
It's so funny, yeah, because there's like certain things that I've just been putting off for weeks. Like, yeah, I'll get to it, and then it's like, oh man, I need to get that done before I leave. So now I'm getting to the thing that I've been
Uh-huh.
pushing off for the past week. So
Yeah,
it's funny
exactly.
how that works.
I love it. I mean, every time I know that I have to take off, it's like those that week before, I'm like, okay, I got to do this, I got to do this, and there's just so much stuff that you get done
Right.
that
You just lock in.
exactly.
Yeah,
Yeah,
you lock in because you want to like be able to just be at peace and enjoy yourself. So you're just, it's go time. Just get it done.
that's right. That
Yeah.
right. So have you been to any 10x Grant Cardone events?
Yeah, I went to Growth Con
Okay.
earlier this year in February. That was amazing. I connected with a lot of great people there. He just like goes like bigger and better.
Where was it? I wasn't able to attend this year. Where was it?
This one was at not C's. It was in Las Vegas, but which
Oh,
resort was that? I'm so mad I can't think of the name of it because when I was staying there, I'm like, oh, I've never MGM. That's what
oh,
it
the
was.
MGM.
Yeah,
Okay.
it was at the MGM,
Hmm.
and it was amazing. I had an amazing time. He definitely outdid itself.
Really?
It was a really good experience.
Who did he have? What was like the
The
main
speakers
top speakers? Yeah.
he had so I messed up, I must admit, because I set my return flight on the last day, maybe I want to say like 2 hours before the event ended. And I should have known that that was not a smart idea. But I figured, it's the last day, and because I live on the East Coast, I'm like, I don't want to make the flight too late, and then it turns into an overnight flight, and then the next
Right.
day I'm trying to play catch up. So I just decided to make it for that afternoon. So I had to leave before it was over, and I missed Mark Wahlberg and Tom Brady. I was so disappointed.
No.
And he never revealed
He
who it
never
was.
reveals.
So
Yeah.
I had no idea like who it was going to be, but I'm just like, please let it be someone that I would be okay with, like, okay,
Missing. Yeah.
yeah. And it was Mark Wahlberg and Tom Brady, and it was like,
Wow.
it was just, I was so disappointed. I was like, next time I can't do that. Next time I have to just see it all the way through. And but next year is going to be in Florida, so it
Oh,
won't be,
okay.
yeah, it won't be on the West Coast, so
Yeah.
I can
It's
afford to.
easier. Yeah.
Exactly, yeah. But
All
yeah, it
right.
was awesome. I really enjoyed it.
That's cool. Well, it's his events are always amazing. I mean, you
Always.
come back inspired and like,
Hmm.
okay, let's conquer the world. Right? Let's
Yes.
go out and conquer the world. All right, let's see here. Not sure, I know we were having some issues with our logins. Did you have any issues logging in?
I did not.
Okay.
Yeah, I was able to just click on the link and come right in.
Okay, I know that I've had some issues. We changed the login and we were trying to figure out, so I'm not sure, but let me make sure here. Let's see. Bill, welcome to the call. I'm wondering if you can hear us. Everybody can hear here? Okay. All right, very good. Well, let's get this started. All right, cool. Well, welcome to multifamily. This is just a multifamily, how to get your first multifamily property, but really we just talk about multifamily and in just different aspects of multifamily. I have been involved in real estate for over 20 years and have done a lot of flips myself personally, probably over 100 flips throughout my career. And did that for so many years and pretty much kind of got tired of the single, single flip, single house, and thought that it was time to enter into the multifamily space. And so 2015 purchased 34 doors in Texas, and I have been able to pretty much just do that full cycle of multifamily where purchased the property, rehabbed it because it was a value add opportunity. We rehabbed it, and by year 2, we were able to refinance, pretty much get all our money back, and the property still cash flowed. And sold the property in 21 at the peak of the market, and pretty much 5 timed my money on that deal, and learned the complete process of multifamily, right? Like how we went out and we searched for the property, we negotiated seller finance, happened. We were able to go ahead and do the repairs. We were able to increase the rents. All of this happened in those 2 years. And then just simultaneously, as you're running the property, you're fixing units as they become available and upgrading them so that you can increase rents as well. But so that's just kind of a little of my background. Sharaine Richards is our guest speaker today. And what I love and what I think is important about this, and just having someone that can walk you through the financial part of multifamily. We can go out and look for properties, but we've got to have a lender and we've got to have someone that has our back and that can kind of make the path much easier. And so I've invited Sharaine to our call today so that she can share, the different opportunities available for multifamily financing, and hope that, anyone that's listening can like either reach out to one of us if for whatever reason you guys are interested and want some more information. Sharaine's information is on her screen, or her backdrop, which is awesome. And I will put mine on the chat. But welcome, Sharaine. It's great seeing you.
Yes, yes. Thank you for having me, Annabelle. It is a pleasure, as always, to see you and to be invited to speak with your community. I think that this is a very important topic that a lot of people would need assistance with, just kind of understanding all of the ins and outs, especially when it comes to the financing. Real estate itself is just one thing to tackle, but when you add in the multifamily and understanding how the financing with that works, I just think it's important to share that information with people and give them some details on how that whole process works. So
I agree.
I'm going to share my screen
Perfect.
and get right into the presentation. All right. Are you able to see my screen?
Yeah.
Okay, let's see. Awesome. All right. Can everyone, you can see that, Annabelle?
Yep.
Okay, perfect. All right. So, as Annabelle said, my name's Sharaine Richards. I own a company called Infinity Business Alliance. I am a business finance consultant, so I help business owners and real estate investors get access to financing and resources to grow and scale their businesses. For today's presentation, the focus is going to be on multifamily investment financing and just giving you a basic overview of it and of things that you can take with you and consider if you are interested in getting started in that process.
Mhm.
So why invest in multifamily property? So there are multiple benefits of investing in multifamily real estate. You're investing in a stable cash flowing asset that appreciates over time. There are many tax advantages that allow you to write off your expenses. There's depreciation where you can write off a lot of the losses that the property takes. There's also a lot of tax deferment advantages where you can defer the capital gains that you get on the property so you don't have to pay taxes on those capital gains, such as the 1031 exchange. You just roll over your gains into another investment property. And there are pretty good returns with multifamily properties, even if you aren't operating the property yourself and you're just investing passively, you can earn returns throughout the year and then get an even larger payout once the property is either refinanced or sold by the general partners. And a lot of investors who do like syndications, they're typically looking to get anywhere from like 16 to 20% returns or higher for their investors once they either refinance or sell. And a great thing about multifamily is, unlike with single family, where you're strictly dependent on one tenant, if it's a multifamily property, the cash flow is going to, there's always going to be some cash flow, even if one tenant moves out, because you have other units where you have the income coming in. And I think the biggest reason to invest in multifamily is it is recognized as one of the fastest paths to building wealth, because you're able to just keep rolling over your returns into more investments and build up a good portfolio. And people get to the point where they essentially are just completely living off of the investments that they've made and the income that they're getting from that. And the great thing about it is that it's such a stable investment that typically real estate will appreciate over time. So if you are looking at this from a long-term perspective, with the right strategy, you can have an investment that'll continue to pay yourself and your family for generations to come. But what is the difference between multifamily and single family? So any property with two or more units is going to be considered a multifamily property. So this can be a duplex, or it can be as much as 500 units and up. Either way, it's all considered multifamily. The difference, the biggest difference is how the financing gets structured for it. So when you're acquiring a property, it's either going to be a residential loan or it's going to be a commercial loan. And if it's 1 to 4 units, even though it is, obviously more than 2 units is going to, 2 or more units is going to be multifamily, it's going to still be structured as a residential loan if it's 4 units or less. And with a property that is 5 units or more, that is going to be structured as a commercial property loan. So the biggest difference between those loans is the criteria. So residential loans are typically a lot easier to attain for first-time investors who don't have a lot of experience, or who don't or who are not working with someone who is experienced with owning real estate properties, whereas the commercial property loans, those are typically structured in a way where the lenders want to see that the borrower has, either the borrower themselves have experience, or they're working with someone who has some experience with operating multifamily properties. An
Shireen,
important,
I have a
yes.
quick question on that. So
Sure.
if someone doesn't have the experience,
Mhm.
and I know in many cases people will bring in partners that have the experience.
Yes.
Does the lender not question that in any way? The lender is okay if you bring a partner in that has that
Yes.
experience for, I mean, like, we can have, let's say, 4 partners or 3 partners for, based on, like, one maybe has the finances, one has the actual like property management skills, right?
Right.
The lender is okay with having multiple.
Right, right.
Okay.
And a lot of times when you are taking on those larger commercial properties, your team is going to be a big part of that because it is a lot of work
Mhm,
for just one person to try to take that on by yourself.
mhm.
So it is important to try to put yourself around people who are willing to work with you to help acquire that property. And as long as someone, it doesn't necessarily have to be everyone, as long as someone on that team who is going to be signing on as a primary guarantor for that loan has experience with investing in real estate and specifically with multifamily is even better, then it's going to be, you have a easier path to be able to get approved for that commercial financing.
Got it. Perfect.
Okay. And another important thing to mention is that even if it is like multiple single family properties, it's more dependent on the unit than whether or not it's a multifamily property to determine whether or not it's considered a commercial or a residential loan. So for example, if you are acquiring a portfolio of 6 single family property homes, that would still, if you are acquiring them all at one time, that's going to be considered a commercial property loan because you are acquiring more than 5 units at a time. And if you are acquiring, say, 3 single family homes, that is going to be still considered a residential property. If you are acquiring a multifamily property where it's a triplex, but it's only 3 units, so that's less than 5, that's going to be considered a residential loan. So I just wanted to mention that so that way you can kind of make that determination.
And when you buy, let's say, a lot, I mean, not a lot, but like a group of, let's say, 10 single family residences,
Mhm.
is that one loan or is that a loan for each residence?
You can structure it as a blanket loan if you would like to have it all under one, and that would be considered a commercial property blanket loan because you are acquiring everything at once. But if you decide, some people prefer that option because it allows you to, even though it's a larger transaction, it allows you to pay for everything once. So you're not paying closing costs for 10 different properties. You just pay everything once under one loan. But if you are going to do it separately, then each property would be considered a residential loan.
And on a blanket loan, would you be able to cash out or refinance
Yep.
like X amount from not one
Yep.
property, but let's say, I mean, how did
All of
they
it.
determine all of them? Okay, so they
Mhm.
would like, they just give uh a value, they value each property, add it all up, and that's
Y-
the loan amount that you get on that lot or on that group of homes.
Right, right.
I
So it
see.
really
Okay.
it really depends on the lender how they want to structure it. So I had a client that was doing a blanket loan, and one lender, they took they evaluated each property separately and said that based off of this is the combined loan to value that we can offer for each, because this property we're able to do about 65%, this property we're only able to get up to like 44%. So they did like a combined loan to value based off of both properties. But then another lender on those same properties with their blanket loan, they said that we can lend 75% of the total value of both properties. So
Oh,
it really
okay.
depends on the lender how they want to structure it,
Mm,
but you can essentially, once you have it all in one loan, borrow against the whole total value.
got it. Okay.
All right.
Interesting. Mm-hmm.
All right. So how do I acquire a multifamily property? So there are a couple options with acquiring multifamily. There's the passive option with a lot of times with multifamily properties, because it's such a large transaction, many people go the route of real estate syndication, where there is like a general partner team. They do all of the due diligence, they find the property, they figure out what the returns will be, and then they raise the capital from other investors who will be considered limited partners in the deal. And then once they acquire the property, they operate it, they manage it, and then they just pay out a percentage of returns to the investors who invested as a limited partner. The second option is for you to take on the role as the general partner, and you're going to be in that role of finding the property, figuring out how to structure the numbers, what the returns will be, and then you raise the capital from the investors to acquire the property. So that's the more hands-on approach, where you're involved in the whole process. And then the third option is for you to decide to just go in with a small team of people, maybe just say you have your team of 4 people, where everybody just decides we're going to put our capital together, and we're not going to raise the money from outside investors. We're just going to use our own money. And in this instance, this is easier to do if you're going to just like start out small with, say you're just doing like a 2 to 4 unit, where it's not going to be considered a commercial property loan. You don't really need that backing of the person that has the experience. It'll be a smaller transaction, so it's a lot easier for you to take down if you have a smaller group. But if you are eyeing, the larger properties where it's going to be considered a commercial property, then in those instances, the transaction is going to be larger. So it's more likely that you're going to need to have someone who has the experience, as well as be able to raise the capital from the investors.
So that would be like, you'd have to probably get an attorney to form that syndication, to form that entity for you, so that you can raise, even though it's private money, or it's friends, or they, like, let's say close people, I think you still have to do that through like an entity, right?
Yeah, if you are, so it depends on whether or not you're raising capital. If you are raising capital from other people, then you have to be compliant with the SEC and make sure that you are going about that and following the regulations appropriately to do that. But if you are just deciding that you are not raising capital from
So like
outside.
coming together, so like I've got a bunch of friends that have money. I say to them, hey guys, I'm gonna go out, we're gonna buy multifamily. You guys want to join in? If we come all together with the money, how do we do with that? Like, where does that money go? How is that money transferred? What's the proper way to do that?
So if you guys, so say it's not a large group, but say it's 4 people,
Okay,
and you are all going to be signing as guarantors for, like, we're all going in on this together. All of our names are going to be on
got it.
property together. In that instance, you're not raising outside capital, so you don't have to be compliant with the SEC and following those regulations.
But
Now,
if but if they don't qualify, and let's say I'm the one that's going to go on the loan,
Mhm,
and everybody else is just going to give me their money,
right.
what do we do there?
Then if the other people aren't qualified to go on the loan, and you're essentially getting the money from them,
Mhm.
then in that case, you want to make sure that you are compliant and make sure that those people are qualified, because then you get into that gray area where you have to be compliant with the SEC, and you want to make sure that you're going about that the right way.
Got it. Okay.
Yeah. All right, so now we're going to get into the multifamily loan options that are out there. So financing for multifamily properties can be structured in a variety of different ways. A good way to think about it is what type of investment strategy that you are going after. So there are permanent financing options, and then there are short-term financing options. The permanent financing options are typically like the agency loans, the banks, the credit unions. And with these options, you're typically the property doesn't require like a heavy lift. It's a stabilized property. You are you are getting into an option where you plan on holding on to the property for a couple of years before you either refinance it or sell it. And with these options, there are usually fixed or floating interest rates. And with the fixed rate, you can have a fixed rate period, and then it switches into an adjustable rate mortgage. And the reason why some people like this option is because typically the numbers work better with these options because the interest rate and the payments are lower. But the reason why is because the interest rate isn't fixed over 30 years. It's only fixed for, if it's a 5-in-1 ARM, it's fixed for 5 years, and then every year after that, it's an adjustable rate mortgage. So with these options, some investors like to get in with these terms in order to give themselves a lower debt amount to start out the gate. But if you are going to look into these options that have the floating rate, one of the things that I would recommend is making sure that you have an interest rate cap. And basically that interest rate cap is put in place to make sure that if interest rates start rising and you have an adjustable rate mortgage, you have a cap at the highest amount that your interest rate can possibly get to. And if you are doing your underwriting and seeing, what numbers work for the property that you're investing in, and you do your underwriting at that highest possible interest rate, now you know that even though I'm getting into an option where the where the interest rate is going to adjust, it's not, even if it gets as high as it can possibly get, we still have a positive cash flowing asset, and we're able to produce good returns. So I think that is something that is not every investor will do that, but I think it's very important because, as you can see, within the last year or two, the interest rates went skyrocketed higher than anyone could have prepared. Yeah, no one was prepared for interest rates to grow at the rate that they went up. And for people that had that interest rate cap, they had already back tested to know that their property was still cash flow at that highest possible interest rate once they met their cap. But for investors that didn't do that, now they're in a market where the interest rates are soaring and it's increasing the debt payment that they have to pay, and the debt may exceed the income that the property can produce, and now they can't afford it, and now they have to worry about it foreclosing and losing their property altogether. So it's very important to evaluate what the cost will be for an interest rate cap if you are going to go into an adjustable rate mortgage. With the short-term financing, this is typically bridge loans, and the purpose of a bridge loan is to create a bridge to get you to permanent financing. And bridge loans are usually the shorter term the shorter term option. So 6 months to 2 to 3 years, because the whole point of the bridge loan is not for you to hold on to the property long term. It's in order for you to go in, whether it's doing, your light renovations, whether it's stabilizing the property, increasing the occupancy, that the whole point of it is for you to go in and do what you need to do in a short period of time, and then either refinance or sell the property before that term expires. So these products, the interest rates are usually much higher, but you're only paying on the interest. You have the principal that's going to be due once the term ends. That's why it's important that if you're going to go into a bridge loan, you need to have a very good strategy with how you're going to be able to increase the income and the equity for that property. So that way, once you refinance or sell it, you can pay off whatever principal that you owe and still be able to have a good payout for yourself and your investors as well. And the good thing about bridge loans is some of them allow you to include the rehab costs into the loan amount. So if you're planning on doing a rehab project, you can ask to have those funds into an escrow account, so that way you can be able to perform your renovations and carry that out. So just be mindful that if you are going into the bridge loan option, you are going to have that principal balloon payment due at the end of the term. So you just have to make sure that if you're getting in, you have a good plan with how you're going to be able to get out of that before it's due. So with the agency loans, these are government sponsored loans. Freddie Mac and Fannie Mae are very popular government sponsor agencies with investors because they offer some of the best terms on the market, but they do have specific criteria that you need to meet in order to qualify for them. So they have some permanent and bridge options available, but the reason why a lot of people like them is because they're typically non-recourse. So with non-recourse loans, the lender cannot come after your personal assets. If things go wrong with the property, they can't come after any of your personal assets that you have. With recourse loans, if things do go wrong with the property and you are personally guaranteeing it, they can come after your personal assets. So if you can get a non-recourse option, that is your best bet to go. And I'm just going to quickly go over some of the qualifications and terms with the agency loans. This is very dependent on the lender, on the borrower, on the property, but I just wanted to give you some general guidelines. So in terms of credit score, they're going to require a credit score of at least 660 to 680 or higher. In terms of the loan amount, these loans typically start at $1 million and up. In terms of the loan to value, which is how much that they will lend to you to acquire the property, they're going to allow you to have at least up to 80%. So that is a number that is very dependent on the investor experience. It's also very dependent on the location of the property and the condition of the property. But at the highest possible value you can get, it will be up to 80%. Terms they typically have 3-year, 5-year, 7-year terms, all the way up to 30 years, 30-year amortization periods. The interest rates can be fixed or variable options. And then the debt service coverage ratio is that's the amount of debt the amount of income the property needs to exceed on the debt. So say for instance, if a property is making income at if the property is making $10,000 a month, that income has to be at least 1.25 times greater than the debt. So it can't just be a 1-to-1. If the property is making $10,000 in income, the debt amount can't be $10,000. It has to be at least 1.25 times or greater. And that number is also dependent on investor experience, the property. You're going to get a lot more. You're going to get better terms if you have some experience, if it's a good property, if it's in a good market, but this is just a general guideline. Also, typically with Freddie Mac and Fannie Mae, they're going to require the borrower to have a combined net worth of 100% of the loan amount and a combined liquidity of at least 10% of the loan amount. So if there's only one borrower who meets the qualifications, then that's all you need. But otherwise, the combined net worth or combined liquidity of all the borrowers who will be signing on for that loan would need to be either 100% of the loan amount and have combined liquidity of 10% of the loan amount. So how do I get financing for my multifamily property? So one good way to give yourself an idea of how to evaluate properties to determine how the lenders are going to look at it is to focus on the key areas that lenders look at when they're structuring their loans. So 4 key areas that they focus on, they're going to look at the credit and the background history of all of the borrowers who are signing on to the loan. They're going to look at the cash flow of the property, which is the income that it's producing from the tenants. They're going to look at the collateral, which is the asset itself. The property itself is going to be the collateral for the loan. And then they're also going to look at the experience of the borrower and see if have they had multifamily properties in the past? Have they had single family properties in the past? Have they owned and operated real estate in the past? So the whole idea of when you're evaluating properties is to give yourself the best possible chance to get financing by looking at it from the standpoint that the lenders are going to look at it when they do their underwriting. So we're going to go through and just quickly talk about some of the underwriting parameters that lenders look at. So as far as borrower criteria, as I said, the commercial loans are usually non-recourse, so you don't have to use your personal assets to back it, but they will still look into the borrower history. Every borrower who signs on to that loan, they're going to look into your history, even if you're not the one who is putting up all of your money. Say you're coming in as the person who's going to manage and operate the property, you're still going, if you're signing on to that loan, they're still going to look into your history and see if there's anything in there, bankruptcies, foreclosures, a lot of errors within your credit history or your real estate profile. They're going to want to see your track record as an investor. Experienced investors are typically going to get the better terms and the better options, but you can still get in as a first-time investor if you have a good plan, if you have a good property in a good market, and it doesn't require like a heavy lift and a lot of rehab. They are going to ask for the proof of funds. That was what I was discussing with the net worth and the liquidity. As far as the cash flow, they're going to look at, does the property have stable and consistent income? Do the tenants pay on time? Are there a lot of delinquencies or collections? With Freddie Mae and Fannie Mac, Freddie Mac and Fannie Mae specifically, they're going to want the property to be 85 to 90% occupied in order for it to qualify for their loans. That's what they consider to be a stabilized property. And again, this is flexible. It depends on the borrower, the property location, and the experience. And then with bridge loans, they don't have the strict occupancy requirements, but if it is a property that does not have good occupancy, then you are going to have a plan in place about how you're going to increase the occupancy and stabilize the property. So that way once the term on that bridge loan ends, you have done enough to be able to refinance or sell that property at a number that's going to be able to pay off that principal, as well as be able to make something back for the investors.
Can I ask a question on bridge loans?
Sure.
What are rates? What is the cost on a bridge loan?
So with rates,
on average,
rates are tricky because it literally changes and varies by the lender, by the day, especially in this market. But the rates that I'm seeing for bridge loans are anywhere from 11 to 12%.
okay.
But they, again, the lowest that I've seen is like around 9%, and the highest is around 12%.
Okay.
All right, so property condition, this is also a very important in determining what type of loan that you'll be able to qualify for. So if it is a property that you have been looking at on paper and it looks like it can be a good investment, before you actually lock in on it, make sure you do a tour of the property with a contractor or inspector, especially if you're planning on doing some rehab to it, especially if you're pretty new to the process, because you want to make sure that they can point out to things to you that you might not have known about as someone who's going in as an investor for the first time. So if you are planning on doing repairs and renovations, you want to make sure that you include a rehab budget in your loan request with a layout of the repairs that you intend to do. And if you're doing a syndication, this is something that you can raise capital in order to have that included as a cost for the investors to raise money to help be able to do that rehab. So you have the option of raising that money or trying to include that in your loan request. If the property needs a lot of work and it has a lot of delinquent tenants, then you may have to do that bridge financing option and reposition it in order to get it into a positive cash flowing asset, and then refinance it into a permanent loan or sell it once you're able to achieve that stabilized condition. Location is also a very big one. It impacts a lot of other things. The location determines how much you are able to increase rents by, because that determines what type of market that the property is in. And it can also impact the stability of your tenant occupancy, because if you're in a location that is declining in population growth, there's really not a lot of jobs, it's, very expensive to live, and a lot of people are leaving, then that location isn't going to be as attractive to lenders. Not saying that they won't lend on it, but they may not give you the best terms for that location. There are some lenders who won't lend in certain locations that they consider high risk areas, where there's a lot of crime, areas where typically there's just not a lot of business growth and the economy's not doing well. Some lenders, they just have decided they're not lending in tertiary markets at all. So the location is a big determinant of what type of financing that you're able to get. Now, and that doesn't mean that you only have to look at the popular markets, because popular markets are a lot of times saturated, and so that makes the properties really expensive. So my recommendation would be to look at the areas surrounding some of the popular markets,
Right.
maybe, an hour and a half, 2 hours out, and see what direction is the economy trending in, where you're able to see in this area, it may not be a popular market right now, but it has been positively trending over the last couple of years. There's been an increase in job growth. There's been an increase in the construction and the businesses that are coming in. There's been an increase in jobs in this area. And when you're able to jump ahead of the curve before everyone else gets there, that's typically when you're able to find those really good deals, where you're able to get in at a good number, be able to work on it and improve the property over time. So that way, by the time everything else starts to build up in that area, you're already set up there.
Mm-hmm.
So as far as the required documentation, the documentation is going to vary by lender, but this is just like a general overview to give you an idea of the documents that they may ask for. So they're going to have you fill out their application. Every lender has their own application. They're going to require a credit check for every borrower who's going to be signing on to the loan. They are going to ask for 2 to 3 months of your most recent bank statements. They want to make sure that you have the liquidity for the down payment as well as the cash reserves. So they may ask to see at least 3 to 4 months of the principal payment, as well as the interest, taxes, and insurance, and a liquid account. They're going to ask to see your investor track record or your real estate owned schedule, which is just basically a breakdown of any past real estate that you've owned previously. They're going to ask to see the purchase contract for the property, any rehab or renovations that you plan on doing. They're going to want to see a breakdown of that. They're going to ask to see the legal business entity documents. So that's the articles of organization, the operating agreement, which the operating agreement is especially important if you are going in with a group of people. They're going to want to see your EIN form, the actual form itself, not just the number. I've had a situation where a borrower just had the number, not her actual form, and the lender would not move forward with providing financing without that form. So she had to get a copy of that form from the IRS in order to be able to move forward. So just the number alone is not enough. You actually need to have the SS4 form from the IRS. They're also going to ask to see the rent roll and the lease agreements, because they want to evaluate the tenants there and be able to see, are they paying on time? Are they paying consistently? And so that rent roll gives them an itemized report of each unit, the tenant that lives there, when their lease expires. They're going to look at, obviously they don't want to see that if you have a 20 unit property, that you have 10 units where the leases are going to expire all at the same time, because that's going to be half of the income that could potentially fall off. So they're going to look into that in detail. And then a couple of other things that I just want to mention as far as
Shireen, a
Yes,
quick question on
yes,
the real estate, like the REO, the schedule.
yes.
Can you put, or should you put, or does it not matter? Do they not look at it? If you are a passive investor on multiple family properties, is that something you put down on there or not really?
Yes, yes. If you've been investing passively,
Yeah,
that still counts as real estate that you have had part ownership in. Even though
okay,
you haven't operated it,
right,
you still have invested your money into that property, and that is still going to be considered a real estate investment for you,
okay,
because even if you're not operating it, if you are investing passively, typically you are still involved in
right,
what's going on with that property
right.
and understanding, they have those investor calls where they talk to the investors
Mhm.
about what's going on with the property and the operations of it. So you still have, even though you don't have experience operating, you have been involved in that process of operating real estate. So
Perfect,
that's definitely something that you want to count for yourself on that real estate owned schedule.
great, thank you.
You're welcome. So what I was going to say is just a couple other things to keep in mind when you're looking at the property and evaluating it and doing your due diligence, is to also keep in mind that when you're looking in terms of physical vacancy, if the property itself has a physical vacancy of say 3%, the underwriters typically always underwrite at least 5%. So that is just a good standard number to use. Now, if the physical vacancy is above 5%, then obviously you have to use that number. But at a minimum, 5% vacancy is typically what the underwriters will use for their physical vacancy. So just be mindful of that. If you are, looking at it and you're doing it based off of, say, we only have a 1% vacancy. Well, the underwriter is going to evaluate it at 5. So that's the minimum number that you have to start with. So as far as lenders in our network, here's just some general terms and criteria that they will work with. So as far as credit score, some will go as low as 620. You ideally want to be at least around 680 or higher to give yourself the best possible terms. The loan amounts start as low as 100,000. They go all the way up to 250 million and up. The loan to value is typically around 75 to 80%. So you're looking at a down payment around 20 to 25%. And there are fixed and variable rate options. There are interest only options. So it's typically going to depend on how you want to structure it for your investment strategy. The terms start anywhere from as low as 6 months, and those are going to be like the bridge short-term financing options. They go as high as 30 years with the permanent financing. And then the average funding time, I typically can get a term sheet to you within 24 to 72 hours. And we can close once we start the process of, once the offer is accepted and we start the process, we typically can close in 3 to 5 weeks for residential loans. So that's going to be the 1 to 4 unit properties. But for the larger commercial properties that are 5 units and up, the turnaround time is going to be around 6 to 12 weeks. So what does the whole process look like? So from start to finish, once you choose your investment strategy, whether it's, say, you are deciding to go for the option where we're going to go for the bridge short-term financing, we're going to go for the properties that may need a little bit more work, go in, rehab it, and then we're going to refinance and sell it. Or you decide to, we're going to go for the properties that are already pretty stabilized, and we're just going to go in, maybe do some light renovations, maybe increase the curb appeal a little bit. And then so our underwriting is going to be based off of the permanent financing options. So kind of have an idea of what your strategy is going to be. And then you're going to choose the market that you want to focus on. Once you have your ideal market, you start looking for properties in that market. Once you find a property where the numbers where the numbers work, that's when you will make your offer to the seller. If it gets approved and you get the property under contract, that's when you want to start looking into your financing options. If you choose to work with myself and my company, we handle that process of finding a lender for you that meets the criteria that you're looking for your particular investment strategy. So what I'll have you do, I'll do like an initial consultation where I talk to you about, what your plans are, what your goals are, what type of property that we're working with. And then I'll send you a questionnaire and have you complete with some of your information, basic information about you, about the property. So that way I can put that together and start reaching out to the lenders that I have that you meet the criteria for. And my goal is to get you offers that are structured in different ways to allow you to be able to see what the different options are depending on what you're looking for. So as I was saying, that there are interest only options. There are options where you have the 30-year fixed financing. There are options where you can do a 5 in 1 arm, a 10 in 1 arm. So my goal is to be able to get a couple of different options for you. And then from there, we can discuss the different offers and see which one is going to work best for your investment strategy. So once you accept the offer, that's when we start the process of collecting all the documents to submit to the lender. And we assist you with the entire financing process from start to finish, basically helping you and advocating for you with the lender, staying on top of things, getting updates from the lender regularly, seeing where we're at in the process, helping you put together the right documents that they're going to request, and essentially helping you get to the finish line is basically what our role will be. So if you are interested in looking into some different financing options, here is my information. You can send me an email, you can call me, or you can even text me. And if you have a couple of questions, if you want to set up a consultation to really talk it through, we can talk about if there's properties that you're eyeing, or if you are, say, just a brand new investor and you're just looking to see what options will be available to you. We can also have a discussion about that as well. So I hope that this presentation was helpful. I hope that everyone got at least something out of it that you can take away and be able to use on your investment journey. Thank you.
I love it. So let's open it up, to questions. Anyone currently have questions for Sharaine? We've got a professional here who can answer, or at least give us some sort of comfort, right, to maybe something that we're not clear about. Any questions? All right. Ray says thank you. All right. Well, everything that you said on this presentation is kind of what I lived and went through myself. You couldn't have explained it any more clear. And, and I think that someone that's looking at this, I'm sure will look at this video. This is just a very thorough explanation of the process for multifamily, whether, when you, from really the beginning of, like, you find a property, kind of what you need to do, right? Like, you really laid it out, Sharaine. You did an incredible job here. And
Thank you.
I will be sharing this. It'll be on YouTube. So feel free, to share it with others, because you did an incredible job explaining all of this. So
thank you.
Thank you so much
I really appreciate that. I actually have a question for you that I think people who are interested in real estate and investing would like to know. So for someone in your position who started out just figuring out this process, I'm not sure if you had someone to assist you along the way, but for someone who's already achieved that milestone of being able to invest in some multifamily properties, what was those obstacles, maybe some of the obstacles that you had to overcome in order to really get things to work? Because it's a lot of information out there. There are a lot of different groups out there, and I think that it can be overwhelming to people who are just starting out. So I think, just hearing about, what was that experience like for you when you first started, and maybe some obstacles that you may have ran into.
Right. Well, I think that's a great question. To be honest with you, I think for me, first of all, I mean, I'm I'm the type of person to just jump into things.
Mhm.
I don't think, I don't overthink a lot of it. I've been in business and I've been in real estate for over 20 years. So I've been exposed to, I was exposed to the single family residence side of real estate. It was no different for me to purchase the multifamily and do the same repairs. It was actually easier to do the repairs on a multifamily because they're all in one building. And you
Mm,
get better pricing than it was to do single family residence and maybe do 2 or 3 homes in totally different areas. So
right.
the transition was very easy for me. When I decided I wanted to go into multifamily, it really took me about 5 years to pull the trigger. This was not an
Wow.
overnight thing.
Wow.
5 years, I had a goal, and I knew based on just kind of my financial situation at the time, and I knew that I needed to make X amount of money. Um, it took me about 5 years to jump into multifamily. And the
Okay.
year before, so like year 4, I determined the location that I wanted to go into, and I was flying out to that location. Now, I live in California. I invested out of state. I was investing in Texas. I'm still invested in Texas, but my multifamily, when I decided to go into Texas, I was just soaking up the information, like just doing a lot of research on areas. I would actually go out there, spend a couple of weeks, and it was just get in my car, drive around, become familiar with the areas. I gotta see it, I gotta feel it, I gotta walk it. That's
Hmm.
the kind of person that I am. I get the vibe, like I like this area, or this is not good, or I don't know. I've just developed that throughout the years. And I think that for me, it just solidified the minute I knew that that was the area I was going to, and I was doing
Hmm.
the research in that area. I became knowledgeable, and just like I am in real estate, like my single family residence. You tell me an area, you give me a house in a certain location, and I can tell you an average price because I already know what that average price is. Well, that's what happened as I was studying the market that I was going to go into. I became familiar with the price per door in the
Hmm.
different areas, right? There's your
Right.
different locations. And so I think it was becoming familiar with that and just doing it. I mean, it was scary, but you know what? I had I knew I had enough experience to go out there and do this now on a larger scale.
Hmm.
And I lucked out. I don't know if, I mean, they say there is no such thing as luck, right? Like just you're prepared for that opportunity.
Right. Exactly.
And the property was not in good condition. I mean, talk about like the perfect deal. That's really what it was. I
Nice.
walked into the perfect deal, and it needed a lot of work. A young kid owned the property. He just wanted out, and he was an agent. I was an agent. We didn't need to hire. I didn't have to hire an agent. We just both, we negotiated. He seller financed for me because that property was not going to perform. I would not have gotten a loan. I honestly, I didn't even know. I didn't even know how I was going to buy that property. I just
Hmm.
said at that point, I said, you know what? I'm going to make an offer, and hopefully he will be interested and he'll seller finance. And he did. I mean, he
Wow.
did. He did a 2-year note for me, which was exactly what I needed. So I went in there and I immediately, you know what? I gave notices because the property was really not performing and the
Hmm.
condition of the property was terrible. So
Right.
I knew that we were going in and we were going to fix, and I probably gave notices to about 5, 6 of those units. And in 30 days, less, because there were a couple that were probably getting ready to leave. In less than 30 days, we just started working, rehabbing really quick. And we had lined up, like the cabinet workers and flooring and like the workers. I mean, we just kind of had it all lined up. And again, that comes from my background, right? Well, we've
Right.
done flips. So you just kind of become familiar with it. And it was I'm not going to say it was simple or easy, because it's not easy, but it was, I guess maybe simple is the word. And we just went in, and you know what, it started improving those units and increasing the rents. And in 2 years we doubled the value of the property.
Wow. That's
Yeah,
amazing.
it was,
That
I
really
mean,
is.
it
Like
really was
you just
amazing.
you went in and trusted your knowledge
Yes.
over of that particular market above anything else. You really didn't know what it was going to take to be able to get it down, but you knew that based off of, what I know about, this market,
Yeah.
this is where we can take it to. This is what the how much, we will be able to do with it. And just trusting your knowledge and knowing that location
Yeah.
is really what made it happen for you.
And you know what? Sometimes people overthink it and they need to
Mhm,
know like every single detail. Yes, I mean that would be great. That's not me. We knew enough to make that decision, to
mhm,
just go in and make it happen. And I think really that's kind of my thing, is like, let's just make it happen, right?
right.
Once you jump in, like, what you gonna sink, or are you gonna
Sink
like
or swim.
sink or swim, right?
Yeah.
So we were there and we're like, okay, we're gonna make this happen. And so, I mean, it's a great story, and I can tell you I've lived the full cycle of that, because we purchased, we rehabbed, we kept the property for about 7 years, and I was able to sell it. So I did the full circle, and
Mm,
1031 exchanged into another property, and 5 times my money.
wow.
And when we bought, we didn't even buy on like appreciation. We thought, because back in those days, Texas was not appreciating as fast as like California was. We
Mhm,
were buying on cash flow. Okay, this is for our retirement. We're just gonna rehab, let it cash flow, and we're gonna increase that cash flow, and it's gonna be great.
right.
And it did.
You
It
had the
did very
benefit of the cash flow and the appreciation.
exactly. And
That's
so, you know
awesome.
what? We took advantage of the market and sold, and you just kind of move on to bigger, better things. And that's the cycle of real estate.
That's awesome. And
Yeah.
how did you with if you're coming in as someone from a who lives in California investing in a property in Texas,
Mhm.
what gave you the confidence to be able to, because you knew it needed a lot of work. Did you already know, contractors in that area to be able to do the work?
So I did have a mentor, mentor. He had already been like probably like 10 years in Texas.
Okay,
So he was there, and that's kind of why I decided I'm going into this area. He's done it,
right.
it worked well. Let's not
Gotcha.
reinvent the wheel. So I stayed there
Yeah.
in that area. But you know what? He had people that maybe we reached out to at the beginning, and they didn't work because they were working for him. We had to find our own people. And you know what? I mentioned, we were out there for sometimes 2 to 3 weeks at a time,
Hmm.
and it was just working on
Working.
property. And you know I talk to everybody, so I need a painter, all right, I'm going everywhere to find a painter, right? I need an electrician, I'll go anywhere, and I'll ask around for referrals, and I'll get an electrician. I mean, it doesn't stop me. And I think that's really the attitude you have to have.
Right.
Just be able to go out and make this happen, because
Right.
if you have to have a list of all the people that you're going to use to help you fix this property, you're going to go in crazy and you'll never buy it.
Right, right.
It helps. I mean, look, it does help. I mean, once, a year went by and we were already working, I mean, we met more people and it was much easier for us to bring in people. But what I will tell you is associating myself with a lot of people in the multifamily space makes a
All the
huge difference.
difference.
I can pick up the phone, call someone in Texas, call someone that knows Texas, that maybe they don't live in Texas, but they have property in Texas, and I can get referrals. So
Awesome.
it's just, I guess it's just been a like just a progression, right? When I went in there, it was just me and my husband and I and our friend, and that was really it. We didn't have anybody else, and it was just us kind of doing what we knew how to do, and you just do it.
That's awesome. Well, thank
So
you. I'm glad that you shared that, because I think a lot of people, I say all the time, it's good to have a plan, but analysis paralysis is real, and you can get so stuck in trying to make sure every step is perfect that you never get started. Like you
yeah,
have to, even you could think that you have the perfect plan laid
yeah,
out. Okay, these are the 20 steps that I'm going to take. And then you get to step 1, you get that done, you get to step 2, and then that
it
step 2
doesn't
that you
work
had in
out.
mind is completely different. And that just
Yes,
changes the whole trajectory of this whole plan that you spent years trying to perfect. So
yes.
just taking that, have an idea and having a plan is a great way to get started, but you can't get so focused and tied into just the plan has to be perfect and I got to have all the steps
Right.
before you start, because sometimes you'll get stuck there and you'll just never get started.
Well, and I'm also the firm believer of, I mean, if you're going to overthink, or you're being too precautious about things, then maybe you should just be a passive investor, right?
Right.
Invest with someone that you trust,
Hmm.
someone that you know, and let them deal with it. We
Right.
did not want to, we didn't want to be passive. We want to be like operators. We want to do this. I mean,
Right.
we didn't even hire a management company. We formed our own management company. We
Mm-hmm.
had a manager on site and a handyman on site. Gave them a discount on the rent. You know what? You're my eyes, you're my feet here in Texas. Call me, weekly calls, or not even daily calls. Anything happens. I mean, they'd be able to take care of it. If not, if it was something big, we'd call an outside vendor to take care of stuff. And so I think you just sometimes have to do these things, and you have to decide. I mean, do you want to be an operator? Do you really want to just passively do this? And I think for us, my personality, it was no, I want to be an operator. Like, I want to be in the trenches. I want to go figure this all out, make it work, and just be a part of like creating a really cool community there for these people. And we really did create a nice community there.
That's
So
awesome.
so it's
That's
it is it's
awesome.
really cool. But thanks for asking me that question, because I don't think I
Yeah,
asked. So
that was a great explanation.
all right. Well, very good. Thank you again for joining me. I'd love to have you come back again. I mean, you have a lot of knowledge on the finance part of it, which is something that I think is super important. This is really the fundamentals of us being able to go out and buy multifamily or any kind of real estate. But thank you again, Sharaine. And again, this is a multifamily call that meets every Wednesday, 2 p.m. of Pacific Standard Time. And I think it's 5 p.m. Eastern,
Eastern.
correct?
Yes.
Yeah,
Yes.
5 p.m. Eastern. And check us out on YouTube, Annabelle Pacheco. This video will be on there as well. And thank you. Have fun in Jamaica.
Yes, thank you. Thanks for having me. This was a great way for me to be able to get my last business taken
Right.
care of. And then now it is
You get to
time
go
to focus
party.
on the vacation.
Very good. Well,
So
thank
thank
you
you for
very
having me.
much.
This was
All
great.
right.
You know I'm absolutely open to come back anytime.
Awesome. Awesome. Thank you. Have an amazing trip. Have fun, and we'll talk when you get back.
Thank you. I
All
appreciate
righty.
that. All right. Have a good
Take
one,
care.
Annabelle. Thank
All
you.
righty. Thank you. Take care. Bye, everyone.
Bye.